In 1913, in Monte Carlo, in a casino, when people were playing roulette, and there were a lot of people who generally bet between a red number and a black number. So the wheel is divided equally between them. So there was a series of black numbers that came, so people kept betting the next one would be red. And that particular evening, the black number came 26 times in a row, and people lost millions.
So, Nimesh, we see a lot of long-term investors who observe the markets very closely. They're either refreshing their portfolio every few seconds, grossly tuned into social media. Does this kind of behavior impact investing?
Absolutely. Attention is a very scarce resource with investors.
Right.
If they start giving it to short-term movement or what we call as noise, typically noise is a short-term information or information or data point which is frankly not useful for your investment decision making, but it's getting bombarded on you through either social media or TV channels or something. It's not helping you in any investment decision making process. By putting more attention to these things, what people tend to do is they trade more. They will keep buying and selling a particular stock. If they bought something for the long-term investment and it goes down a bit, they start getting anxious and they will sell it the moment it comes back to their break-even price and want to get out of that. It tends to take them to herd mentality. It makes them vulnerable to herd mentality. Also, if you trade much or if you keep looking at short-term movements, your investment horizon also shrinks. So while you may come into the market for creating wealth over say 3, 5, 10-year period, but if you keep watching your portfolio very closely, it disturbs your long-term horizon and makes you more short-term or trading oriented.
Right. But does it help in analyzing any short-term market movements that may occur?
So there are many studies that have shown that day-to-day trading in the market has not really benefited a lot of investors or traders. We did a small study to analyze like all this kind of analysis that is being done on market movement on a daily basis. So we took about 21 years of data and we found that 65% of the time the benchmark index, a Nifty or a Sensex, they move less than 1% up or down. Now imagine those 6 hours of trading and many hours pre and post trading are being used to keep analyzing these movements, right? So it creates a lot of noise and people trying to justify short-term movement, but frankly it doesn't help long-term investors.
Right. So what are the most common behavioral mistakes that people tend to make when they watch the markets as closely as this?
So we often say that time in the market is more important than timing the market.
Right.
And giving your attention to short-term movements makes you vulnerable to timing the market, or you're tempted to time the market. And there are two very important mistakes or fallacies that people make in doing that. First is called a Monte Carlo Fallacy or a gambler's fallacy. Typically, if you toss a coin 3 times and all 3 times it gives heads, and next you are asked, like, for the next coin, what would you bet, head or tails? Most people would try to bet tails, that because 3 outcomes were heads, the next one should be tails. What we are trying to do is put an averaging or a mean reversion on short-term outcomes, and the mean reversion only works in the long term. So over a huge number of these tosses, heads and tails are almost equal, 50-50. But we tend to expect it to happen even in the short term, in the few tosses that we do. So that's called a gambler's fallacy. Why it got the name Monte Carlo Fallacy also. In 1913, in Monte Carlo, in a casino, when people were playing roulette, and there were a lot of people who generally bet between a red number and a black number. So the wheel is divided equally between them. So there was a series of black numbers that came, so people kept betting the next one would be red. And that particular evening, the black number came 26 times in a row, and people lost millions. So it's also called as the Monte Carlo Fallacy, where you are, because the dice or the roulette doesn't remember what was the previous outcome. It's just moving on a random basis. The opposite of that is also a fallacy. When you are saying that gambler's fallacy is about expecting mean reversion within short term, there's another fallacy called the hot hand fallacy, which is about expecting a trend to continue just because there are few data points that say this trend is continuing. So hot hand fallacy comes from basketball. A lot of fans, when they see a player making a few baskets in a row, they say that player has a hot hand. He's on a streak. So we will see more baskets from that player. Now, in markets, typically some people will say that if, say, foreign investors have bought 3-4 days in a row, there is a lot of foreign money that is coming. People tend to extrapolate that okay, now the foreign investors are viewing the country very favorably, and this money will keep continuing. So expecting mean reversion is also a problem when you look at very short-term data, and expecting a trend to start just because a few data points have come is also wrong. These kinds of timing issues get people into trouble and lead them to substandard returns.
Right. So, picking up from where you left last, which is substandard returns, does the noise affect an investor's stock selection? Will I tend to pick incorrectly if I'm hearing all the chatter around me and not really doing my analysis properly?
Absolutely right. See, when investors look at very short-term movements, a small drop gives them pain and agony. A small rise gives them happiness. So they keep going through this emotional roller coaster on short-term movements. It is difficult to book losses because you have to admit that you were wrong. It is easier to book profits. So typically people who watch the screen too much, they tend to book profits early in what they have got right and keep the losers in the portfolio hoping that they will come back to break even soon. This is called a disposition effect, and it does affect the quality of the portfolio ultimately that the investors end up with. The second research done by Terence O'Dean was about all that glitters, as he called it. That people tend to pick up those stocks or those companies which are attention grabbing. So if that particular day a company is in the news, if there is a sharp movement in volumes and price, people tend to take notice of that, and then they are more likely to be chosen in the portfolio than the ones which have not made any noise on that day. This again leads to problems, that a good company may be lying quietly and a good investment may be there for the longer term, lying quietly, but people don't look at. And it is quite possible that when you're going for these attention grabbing or glamour stocks, you may end up chasing the performance. You may end up investing in these companies when much of their run is already done with. So that's also a problem when you are only focused on noise and attention grabbing companies.
Right. So in our last episode, when you were talking about conforming to herd mentality, you gave us a very good example of how to have a contrarian point of view to overcome this bias, right? So how do investors overcome now, the noise, the chatter, the attention that we pay to all of this around us?
So as I said, attention is quite a scarce resource for us, and we should put it in the right side of our investing. Investors should focus on the long term. I'll tell you a small case that happened when I was a few years back in Hong Kong. I took a boat ride to a place called Stanley and with some friends of mine. And I'm not very used to such trips. So I was feeling a bit of motion sick. So I asked my friend for some medicine if I can get some. My friend said, no, don't worry about it. Just stare at the horizon. I didn't know whether it would work, but it did. And then I researched about it, and it's quite scientific that it does. So I tell investors, if you're feeling a little motion sickness because of the volatile market, just stare at the horizon, stare at the long-term goal. Then everything becomes a little clear when you're looking at a more long-term investment-oriented approach. Many people because of short-term movements get disturbed. It's better to wear something like a noise-cancelling headphone where you avoid certain data that is coming. Stick to your investment process, focus on the long term, and if a new information is to be incorporated into your investment decision, see to it that it has the right weight to be incorporated in your system. Through that, you will be able to distinguish between what is a signal and what is a noise.
Right.
What should and can affect your investment decision and what should be just ignored.
Got it. All right. Thank you so much.
Thank you.
Thank you for joining us. Stay tuned for more.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.